Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. My guest today is Ron Insana, and if you don't know who he is, come on, get out from under that rock or ask your Gen X friend in finance. This guy is one of the most well-regarded, or baby movers, right? But one of the most well-regarded financial journalists. And he's had experience as a hedge fund manager. He's author of books. And I'm really excited to talk to him about the markets and one of the hottest topics today, artificial intelligence. Ron, thanks for joining me on the podcast.
My pleasure having me. I'm sorry for interrupting you during the introduction.
It's quite all right.
Old habit, actually.
I was prepping for the call or for the podcast here, and looking at your books. Got any others coming? It seems like today's market is just great fodder for another book of some sort.
I am contemplating one. I've written part of one, which is highly personal. It's more of a, not to go too deep in the weeds on my personal life, but it really has to do with my relationship with my dad and money, and what motivated me to go in the direction that I did relative to the path he took in life. And so it's something that it's an exploration. It may just well be a psychological exercise for me. Whether or not someone else finds it interesting, I think, is an open question. But it's the one thing that I've kind of played with over the last couple of years. I haven't put a book out since 2009. So the only other topic that really intrigues me is how we would build the American economy if we started from scratch today. And what that would look like if we were able to kind of really reimagine the U.S. in modern terms with the technologies that are available to us and kind of start from scratch. That's been intriguing to me. It's very, very hard, if not impossible to do. It's like, it's kind of like fixing an airplane in flight. But I think there are a lot of intelligent ideas that are out there with respect to economic development that probably should be tried at this stage of the game. And would love to see how it would work in practice.
That's super interesting. I'd read that book. And it makes me think of another story, another topic that we are talking about at our shop too, which is India. And the reason why I mentioned that is because of the technology and the digital landscape that they are building. They can almost just leapfrog the rest of the developed world in terms of technology and kind of start from there. And as you were describing that, it almost sounded like, okay, if we could rebuild the economy, what would it look like?
Yeah, they can. I mean, it's what's intriguing about India is I think a couple of things. Number one, if they did what China did 30 years ago, they would become the single most important economy in the world. Their biggest problem is political, as is the case in many different countries. But they are, in a sense, more divided than the United States, not from a partisan perspective, but really when you break it down regionally, when you break it down from an efficiency standpoint, the rural hinterlands of India are inaccessible, do not have access to clean water, healthcare, education. It's intriguing to me that, India probably has the most potential of any economy over the next 50 years if they were able to get their political act together and really address the infrastructure issues that they have. And again, use that kind of leapfrog technology to get there. Their middle class is the size of the United States population. So it would be pretty interesting, far more interesting in my mind than China is today, which I think is becoming or has become an Orwellian surveillance state that it's dampening productivity. That's, property accounts for 30% of GDP. That's in free fall. And China doesn't even look interesting to me as an economy. As a military power and a technological rival, yes. As a real economy, absolutely not.
Yeah. I mean, they're a democratic, economy and nation, and they're seems like they're getting their stuff together. Yes, there's challenges with politics, and Modi just went through a challenge, but I think that actually might help kind of tamper his other policies and keep some of the regulations he put in place.
Yeah, and I mean, their other biggest split, is along religious lines. Like a lot of different countries. I mean, the difference between Hindus and Muslims has been extremely strong, and the rivalry with Pakistan, and even now territorial disputes with China are an unnecessary and unwelcome distraction. So they do have some challenges, just away from kind of simple politics, if you will, and never that simple. But again, I'm intrigued by them. I hope they lean westward over the next couple of decades, that would certainly help us out. It would help us expand our supply chain opportunities as we wean ourselves off, Chinese goods. But we'll see, because India's always, for decades now, been very good at playing everybody against one another, whether it's China, Russia, and the U.S. They seem to find a nexus there that's probably frustrating to everybody that's served.
They've been, threading the needle their own way, I guess.
Yeah.
That's awesome. I didn't expect to have this conversation on India, but it just kind of where it went. I love it. If we bring it back to the U.S. and challenging times, one of the other things I just wanted to ask you, kind of given your experience as a financial journalist, was how do you make sense of today's media landscape as a regular Joe? How do you navigate the news? Like, for instance, I was on a certain platform and I saw two different articles about the same topic saying totally different things. Like,
I hope it wasn't art.
No, no. It was like, no one's selling their house because they got really cheap mortgage rates. And then maybe separated by a few days later, it's like, all right, people are starting to sell their house and rates are going up. Like, okay.
Yeah, no, I've seen that too. And I've seen that supply is up pretty dramatically from last year. It's being unlocked as mortgage rates have effectively held steady. I think, there is kind of a threshold at which people get, I'm not going to say comfortable, but accustomed to the level of rates. When I was growing up, my later high school and early college years in the late 70s, early 80s, you were looking at mortgage rates that were between 14 and 18%, depending on your credit score, right? And so people did shockingly get comfortable with that and mostly used adjustable rate mortgages, which is the exact opposite of what we did 4 or 5 years ago, where everybody was using fixed. And when you look at the Redfin data, right, it's like 90% are below 6, 80% below 5, over 60% below 4, and over 20% below 3% on mortgages. That's one reason people were locked in, right? They wouldn't sell their homes because any move that they made, lateral or even to downsize, would result potentially in higher costs. I think people have they've adjusted to this new reality, and so homes are coming onto the market. They're getting sold. And in New York, it's interesting. I just saw an article this morning that it's become more of a buyer's market than a seller's market. So I think we're just transitioning to what is a far more normal environment. And I think people don't realize this, particularly younger people, who grew accustomed to a 12 to 15 year period in which interest rates were historically low. Right? I mean, in the history of the world, zero didn't happen until the great financial crisis. Merrill Lynch years ago put out a 5,000-year history of interest rates, and the period post-GFC was the lowest we've ever had over a 5,000-year period. So everybody got accustomed to doing business effectively at 0 or 1 or 2 or 3%, and now that there's sticker shock. But again, I think they're becoming accustomed to it. They're making adjustments, and they're trying to find their way around. I think if we got a lot of supply in the housing market in the next 12 to 18 months, prices would actually fall, particularly if the Fed cuts rates, which I expect sometime this year they'll do. And that'll loosen up the real estate market rather considerably and make it potentially more affordable for either those who want to downsize or first-time buyers who are still, struggling to make that payment.
So you're one of those that think that the Fed's going to cut rates later on this year.
Yeah, I think they should do it in July. I think, I think the ammunition's there. I mean, the economy isn't necessarily slowing, but inflation has come down. The data we got last week on the PCE deflator, the Fed's favorite inflation gauge that's included in the personal income and spending data, was running at a 2.6% annual rate. And that's within spitting distance of the Fed's target. They themselves have said, among the various Fed officials, mostly Jay Powell, Austin Goolsbee, and some others, that if you wait until you hit the target, you're tightening. And they don't want to be tightening in an environment like this. So at 2.6, 2.5, they could start cutting, once or twice this year, and then maybe 3 or 4 times next year. And I think to normalize rates and get them roughly even with the inflation rate, they've got to come down 1.5, 2 percentage points over the course of the next, I would say 16 to 18 months. And so that's kind of my base case. It got pushed back because the first quarter inflation numbers were higher than expected. I think a lot of that was statistical noise. And I would agree with Tom Lee of Fundstrap that inflation is likely to fall pretty hard in the second half of the year.
Do you feel that the rise in interest rates have started to affect earnings for companies? And is that something to watch?
No, not yet. I mean, geez, we had a 9%, year over year gain in S&P 500 earnings in the second quarter. And It'd be harder comps in the second half of the year, where it might be a little more difficult to show big gains. But the market doesn't seem to be discounting that right now. And I was looking at some data. If you're up 15% in the first 6 months of the year on the S&P, which is roughly where we are, we've never had a down year. And we're also in the fourth year of a presidential cycle, which is typically the second best of the 4-year cycle. We're actually ahead of last year's pace. So it's, I don't know what the market's discounting from a political perspective, probably nothing yet. But it does seem that with Atlanta Fed GDP now figures, showing 3% current growth, we're not really slowing down. Earnings are fine. Rates are probably coming down. Inflation's probably slowing. It seems still to me to be a pretty good environment for equities, and bonds are going to chop around, I think, for the remainder of the year.
Do you have any concern about the concentration in the market, like with Nvidia powering everything most recently?
I just wrote a piece about that last week for CNBC.com. No, actually, and normally I would, and it was kind of disturbing to me that I wrote the piece, because it kind of goes against columns I've written in the past in 1999 or other periods where there was heavy concentration and only a handful of stocks accounted for the gain in the S&P 500. I think for now it is what it is. Whether you want to compare it to the Nifty 50 of the early 1970s or any other period, the companies that are driving the market are cash rich. They're growing abnormally fast. Maybe that comes to an end at some point. But when comparing it, let's say, to the internet bubble, I still think we're closer to 1995, 96 than we are to 1999. We're going through transitioning from the infrastructure phase of the AI build out to the implementation phase. And that was kind of what we did in 95, 96 in the internet bubble. AOL and Netscape and all the Yahoo and everybody else came out. And then other companies like Amazon and some of the big winners over time came later. And we, again, we went through a period of digestion. Obviously, the internet bubble burst. But what's interesting to me is after that happened, you had full deployment of all those services over the next, 15 years. So there will be a period of digestion. There will be some sort of event once this reaches kind of peak insanity, which I don't think we're there yet. I mean, I have no relative that has called me yet to ask me about Nvidia or, some AI stock.
That's a great bellwether, by the way. Yeah, exactly.
Yeah. In 99, people were calling and asking about KTEL and Zapata.com and, theglobe.com and all these other nonsense stocks that were out there. We haven't reached that level of, I think, public, mania. And we haven't seen, hundreds of IPOs of unprofitable companies like we did 98, 99 going into 2000.
Do you think that despite NVIDIA's run up, do you think there's an opportunity for other sectors in the market to participate, maybe being driven by the AI theme, whether it's in power or semiconductor chips or other things like that, data centers?
That means they're up 31% year to date. So Micron's at, AMD, everybody who's kind of building out domestic manufacturing and also accelerating the development of more advanced computer chips and been doing quite well, in this marketplace. And that there are others who are suggesting now that they're, building chips that could rival what Nvidia has built. I mean, that's maybe a dubious claim, but they're certainly trying to accelerate the development of more powerful chips that will be used in, not just GPUs that have used in both in video games and in AI development, but, for other reasons as well, cybersecurity, what have you. Yeah, I think there's still selective room on the upside for those. But I ultimately, the market may broaden out. What's interesting to me about that argument, by the way, that going back to your concentration question, people make the comparison between the S&P and the unweighted S&P. I don't know anybody who buys the unweighted S&P, right? It's the biggest divergence between those two averages, I think that we have on record. Nobody owns the unweighted S&P. So if you're long the S&P 500, whether it's the Spider or some, a Vanguard fund or a BlackRock ETF, you're still up 14% for the year, and you're up 24% total return last year. So, it's kind of hard to argue with that right now, unless or until there is some intervening factor that changes it. And that would have to be inflation, in my mind anyway, inflation turning higher and the Fed not lowering rates. That would lead to, I think, a significant correction in the marketplace.
Not lowering rates by this month, July, or not by the end of the year?
My preference is the end of July, given that they've gotten the data that they need, I think. I mean, we'll get more employment data this week as well, which may tell us whether or not the labor market's cooling. There doesn't seem to be, unanimity of opinion that they're going to lower at the end of July. Everybody seems to be targeting September now. I mean, people take them way too hot with expectations the Fed was going to cut 6 or 7 times. They'd start in March. My base case was 3 cuts, beginning in April, May, or July, somewhere around that time. But now it looks like it'll probably get pushed off to September. And then they have to lay back until after the election so as to not appear to be politicizing Federal Reserve policy.
Yeah, that makes sense. So if they're going to make a move, they're going to do it before September.
Or around September, and then just kind of live low for a while. Donald Trump has already suggested that the Fed's going to try to help out Joe Biden. He's also suggested that he should be in charge of the Federal Reserve and part of Project 2025 and some of these other plans for a Trump administration would include consulting the president on interest rate decisions. I don't care who the president is. That'd be the worst possible move that they could make with respect to the independence of the Fed.
Let me bring it back to the topic of the day, which is artificial intelligence. And we can talk a little bit about your business as well. But, so artificial intelligence has been a major driver of equity markets this year as an investment. But also let's talk about it as the potential to help investing and, of course, every other sector that's out there. Do you think AI can help investors allocate their portfolio or be a tool in managing investments for them?
Well, I certainly hope so. That's the business I'm in addition to being a contributor to CNBC and MSNBC and being on the speaking tour and all that. I'm the CEO of a division of a larger company. My unit is called iFi.ai, and for individuals, we provide individual stock forecasts on a 1-day and 30-day cycle, a period, if you will. Coupled with some, instructional videos with some interviews and some additional content that's added to that, with the idea that if there's a stock you already like, you can come to iFi and take a look at the probability or the expected rate of return over a 1-day or a 30-day period. And so that depends if you're like a 0-date single stock options trader. We have the 1-day forecast. If you're a self-directed trader who's fairly active, you can look at the 30-day and get a better sense for what our model is expecting that particular stock to do. So XYZ may be up 10, 20% over the next 30 days. And look, there have been some really outsized forecasts that we got that have kind of caused me to question the model itself. At one point, we had Tesla going up 40%. It was in the tank. Next thing we know, they report earnings. They make a forecast on their own that they're going to do something new with a less expensive car. Stock goes up 35% in 5 days. So, do we believe that that's going to be a tool? Absolutely. We have that for self-directed individuals. We also have a tool for investment advisors that has portfolio analysis, portfolio construction tools, asset allocation modeling, which again, in that space, there's been pressure on investment advisors to do less of the investment decision-making and do more gaining wallet share from their existing clients or prospecting for new clients in order to grow their businesses. So to the extent that we can assist in the investment decision-making process, we feel that iFi FA, which is a financial advisor component of that, will be useful as well. And you're seeing, we're not the only ones doing this. And you see Morgan Stanley using OpenAI for the more mundane tasks that a lot of advisors have to deal with on a day-to-day basis, which you're seeing across all industries, legal services, professional services, using these various tools, as we did with the internet to, kind of make each job more efficient or more productive. I think that's the way in which AI is going to be used. I think it's going to be really extremely useful in healthcare. And you hear this from a lot of people in terms of diagnostic tools, drug development, identifying, mutations and viruses and things like that, which you could do much more quickly and apparently much more accurately than humans. Even reading scans, it may be more effective at doing that. So, I like I say, we're moving from the infrastructure phase to the implementation phase. And I don't think that process has played out, not even a little bit. It's just in the early stages, although the adoption is very rapid.
Do you think there's different models to play out? I mean, there's different providers of different AI. Is it going to be a beta versus VHS type of battle, or are they all going to exist?
I think they may all coexist. We happen to be very tied into IBM's Watson X platform for a wide variety of reasons. They can take in, as we do, 1 million bits of information every night. They run 50,000 models for us for the institutional side of our business, which also bleeds over to the individual side as well, where we're analyzing 50,000 global publicly traded stocks and, creating these forecasts each and every night. And Watson X is a powerful tool. It corrects for drift. It corrects for bias. IBM, along with others, but IBM is about to make the leap to quantum computing, which is going to add speed, depth, and accuracy to the process. And so we're looking forward to that. And we have a very solid partnership with them. And we really kind of admire what they've done in that space. And, when you're looking at any kind of tool like this, and this was true going back to any form of computerization, internet development, garbage in, garbage out is a risk. So we want to make sure that we have the highest quality data on which the forecasts are based. And we found that IBM is particularly good at that.
Now, on the individual investor portion of it, are there the opportunity to build portfolios, or is it really just if you want to make a trade?
You can, and it's something we're looking at too, as to whether or not we put up our own, right? Model portfolios or our top 10 best ideas, both long and short. You can pretty much do this on your own, simply because we have an entire list of publicly traded stocks in the U.S. plus ETFs. And those forecasts are updated daily. So you can see that, in some instances, they'll switch positions from number 1 maybe to, number 20. But there are a lot of ways in which you can construct your portfolios based on the data that are available in iFi.ai. Yeah.
And so what are the different versions? Or you have iFi.ai maybe for individual investors, and you said you have an iFi for FA.
Yep. And
an institutional version too, or is that the same thing?
Yeah, there is. And so the parent entity is largely involved in the institutional space, where there are portfolio construction tools. There are bespoke indexes for large banks that want to have asset allocation models that they sell into their ultra high net worth or high net worth clientele. There are products that go into indexed annuities for some of the firms as well. And some of these firms may make their own adjustments to it. They may put volatility caps on it. So if they want, a vol of 5, that may reduce the return. But if you're in something like an index annuity or a variable annuity that wraps around an index, but wants to limit volatility, which a lot of insurance companies do, you get then kind of a more modified rate of return, but it's generally, if it's done right, steadier and more reliable. And so when you're looking at those kind of long dated assets like annuities, you want a steady stream within it, right? You may want less vol, even if you're giving up a little return. That's the way a lot of variable annuities, indexed annuities are constructed, with or without us. But that's a space that we play in as well. And like I said, there's about $6 billion under advisement that utilizes those institutional tools that we have across a wide variety of large international banks.
Does the model have a certain philosophy in investing, or what's its target?
Not that I'm aware of. I mean, no one certainly told me that yet. The firm is 7 years old. My piece of it is considerably younger. Philosophy is it has a guiding set of principles, and it ingests information and arrives at a set of conclusions based on signal inputs that are ranked in order of importance, both by positive and negative. And if the positives materially outweigh the negatives, you get a positive forecast. And the opposite is true if the negatives outweigh the positives. And there's a degree of confidence and a degree of historical accuracy that's measured as well. But philosophy, not that I'm aware of. I mean, certainly the data scientists and our chief investment officer have the ability to launch retrainings. But I think the whole point of AI is not to impose a particular philosophy. It's to let these models cull as much data as is possible, and considerably more than any human can do in a single day, and use all the data to derive these signals that then drive forecasts.
Yeah, I mean, I guess its goal, right, is to affect the best return over some given period of time.
Which by definition means it doesn't have a philosophy.
Right.
I mean, there are a lot of folks, who I greatly respect over the course of my 40-year career, who've done fundamental analysis, technical analysis, have developed tools that have been quite useful. But all of those go into the model, right? And then they're weighted based on their importance and their accuracy and their contribution to a positive or negative score. Do we impose a, value versus growth approach to investing? No, absolutely not.
Yeah. And so as a human and a human that's covered a lot of different markets and people, and do you have a personal investment philosophy for long-term investors or just for yourself?
I mean, look, I think at the most basic level, and I've joked about this a lot lately, that if I were ever to write another investment book or a book that, deals with investments, it would be 3 pages long. It would be 60% S&P, 30% NASDAQ, 10% Russell, and then the remaining 243 pages would be pictures of my family. Because I think at the end of the day, I mean, if you're talking about generating retirement income and you're really looking at a 20, 30 or 40 year horizon, and I have 3 Gen Z kids, right? Technically, I would, and I have told them this, it's just put as much money away as you can, in your retirement account. That should be all S&P 500 or some combination of, various indexes and maybe some fixed income, and never look at it again until you're ready to retire. I think in the most simplistic form, for people who have that kind of time horizon, who are just legitimately trying to save as much money as possible and max out their various retirement vehicles, that makes the most sense to me. There is no 20, 30 or 40 year period in which you didn't make money, and a reasonable amount of money compounding, your investment holdings in stocks. If you'd invested in 1929, if you had the money, or if you invested in 1932 at the very bottom, when the Dow was at 41 in July of 1932, market went straight up through the remainder of the Depression. Not straight up, but it went up through that period, through World War II, and on and on and on, and with a wide variety of interruptions in the process. Even in our modern experience, my first live reporting experience after being an anchor for 2 years was covering the crash of 1987. We fell 23% in one day on October 19th, 1987. I thought, having done some reading and research and talking to a lot of people, that this was going to usher in another Great Depression. It didn't. It took us a while to come back, just as it did after the internet bubble burst. Then we had, of course, the great financial crisis, in which we literally strained the global financial system to the breaking point. And yet here we are, considerably higher than we were. And we had the pandemic, and we crashed there and came back. So it's hard from a long-term perspective to tell people to do a lot of things other than just put money away in the market and sit on it for 20, 30, 40 years, depending on what your time horizon is. When it comes to trading and making shorter-term decisions, I think these tools become more and more valuable. Because quite frankly, look, I mean, and Warren Buffett said the same thing. For most people who are just saving money, whether they're putting it in a banking account or whether they're putting it in the S&P 500, that is the simplest, cheapest, most direct way to let your money compound over time, which is the single most important aspect of investing for a long-term, set of goals. Shorter-term stuff is entirely different.
So as we start to wrap up, one question I like to ask guests, and this is an opportunity to go totally off script, whatever's top of mind. It could be about what we talked about, but kind of given your vast experience, I'm really curious what you might say. What's one long-term trend that you see playing out over the next year or several years?
Well, it's hard to say that AI is not it. I mean, and the way in which it's going to be deployed. I use, when I'm out speaking to audiences and groups around the country, what we would consider mundane uses of it are showing up in places like fast food restaurants, in medicine, healthcare, legal services. I don't think that's a trend that we can get away from or talk about. The other trends, I think a lot of trends are going to be dictated by whatever, particularly in the United States right now, whatever the political environment looks like, because there are some big questions that, not ahead of the election, but after the election, that involve regulatory issues, how much flexibility and latitude businesses will have under a Trump administration or a Biden administration. There will be tax-related questions that are going to be extremely important to businesses, whether they get that tax cut or whether the Trump tax cuts are rolled back. So I think not until after the election will this matter. And I think we still don't know. We don't know about November 5th. There's a lot of hand-wringing going on the Democratic side. There seems to be a lot of euphoria on the Trump side, given yesterday's Supreme Court decision and such like that. But I still don't think we know specifically what the outcome is. We don't know what the composition of Congress is. Once that falls into place, I think we'll be having a lot of conversations about how business will be affected going forward by either administration. And we'll also be talking about debt and deficits, and again, probably in ways that while we talk about them today, those conversations may become more intense. And I think that too will determine, how bond markets fare, how the dollar fares. And so I think that will be a big deal next year, but not until we know. As we get closer, the markets may start to anticipate things, particularly if the outcome becomes increasingly clear, given what we think are numerous variables that will, predate the election. If it becomes really clear one way or the other, the markets will start having a reaction to that, and it will split, along sector lines. The bond market, may perform a certain way. The dollar may perform a certain way. And I do think this will be, without being political, I do think this is a consequential election that will impact markets going forward. So AI is going to happen irrespective of that. But I do think there are going to be a lot of themes that will be played once we know what's happening after November.
With the few minutes that we have left, we do a speed round called Trend or Fad. Can I ask you a couple topics? Get your quick take. You can explain it if you'd like to. Cryptocurrencies, trend or fad?
Fad. But I say fad in the sense that crypto, in my mind, is still a solution in search of a problem. I don't think Bitcoin's going to replace the US dollar. In my mind, it's not really money. It's even less so than gold. But I think it's a tradable virtual commodity, if you will. And so it will be around for some time to come. I just don't think it's going to do what people thought it would do, which was to become the reserve currency of the world. So in that regard, I don't think it's met its objectives or goals, but it's something that people will trade and will have the opportunity to trade for, at least at this juncture, for as far as the eye can see.
Maybe related to that, or actually, no, maybe related to our other topic, nuclear power.
Hopefully trend. When you look at the developments taking place in nuclear with these far more intelligently designed modular nuclear power reactors, still fission, not fusion, they become less expensive, they become safer, and hopefully siting and licensing will get easier, and the sort of NIMBY, not my backyard type opposition, understandable post 3 Mile Island, post Chernobyl, post Fukushima, that this will become a bigger piece of our energy production. Already you see that the AI business, because of the drain on power that's required for all these data centers, they're actually contracting directly with whatever nuclear power facilities we have right now to get hooked up. And so as our power needs increase exponentially over the next decade, I think nuclear, along with wind, solar, and natural gas, are going to be an ultimately key component of this as well. I think nuclear is going to become an increasingly important piece of the energy puzzle.
And then this last one was something that I just started thinking about because I've been hearing it and just taking it for granted. Then I heard you say something on another video about longevity science and what have you. So I'm thinking about the topic of the great wealth transfer.
$90 trillion.
Yeah. So trend?
Oh, absolutely. I mean, well, without a choice, right? I mean, unless we were to have some, truly horrific event that wiped out the $160 trillion in household net worth right now. Again, about 90 trillion of which is going to pass from baby boomers and Gen Xers down to millennials and Gen Z. Absolutely a trend.
Fantastic. Ron, this has been a great episode. It's been a pleasure to talk to you. What's the best way for people to learn more about you, learn more about iFi and what you got going on?
So I'm on LinkedIn, I'm on Facebook, I'm on X or Twitter, whatever the heck it's called these days. I'm Instagram, but iFi itself is i-fi.ai. It's a URL that we kind of got stuck with because of just the way in which names come down, but it's i-fi.ai, iFi.ai. And there's a variety of ways it can be accessed for free. We have iFi Free, iFi Fan, iFi Fanatic. Those are 3 different price points. And then for financial advisors, that's something that we do on kind of a more hand-to-hand basis. That platform doesn't exist for people to access necessarily directly. So we're in conversations with a lot of different firms to talk about how they can utilize that platform for their benefit as well.
Fantastic. And got some content on there. That great video that you did on artificial intelligence, it's up there. Check that out. So cool. Thank you, Ron.
Thanks, Ed.
And thank you for tuning in to another episode of Trends with Benefits.